Avinash, in just a bit, but there's an interesting note coming through from Nomura on AU Small Finance Bank. And there's a significant downgrade in the price target for this company. It's also changed its rating on the stock. We've got Harsh joining in to tell you why and what they're seeing in this report. Harsh?
Well, they've downgraded AU Small from a neutral to a reduced the target price from 580 odd to 500 rupees. 16% downside is what they see on the back of numbers, and that's what's really standing out. One is your asset quality has deteriorated, and the margin moderation has really led to the softer performance, according to Nomura. Credit card will likely see credit costs peak at this point, is what management suggested. They're also saying that MFI will take 2 to 3 quarters to improve in terms of its credit quality. So MFI will continue to create pressure on credit costs. So what Nomura has done is they've hiked the credit cost expectation over the next 2 years by around 0.3%. They're now building for credit costs of 1.85% for FY26 and 1.7% for FY27, which is what is leading to an earnings cut. You're seeing that earnings cut also build into valuations as well as ROA. So what's happening on the ROA front? ROA expected to be around 1.4 to 1.5%, ROE of around 13 to 14%, and they're now valuing the company at 1.8 times December 2026 price to book versus the September 26 price to book at 2.1 times. So you're seeing a cut even on the multiple, which is why you're seeing that target price being cut quite sharply from 580 to 500.
Important to note there. Thanks, Harsh, for getting us those details. In fact, Nomura is sending out one more note, and this is on a stock that was in my list, Credit Access, on the downside, certainly. It has, in fact, tagged the stock as reduced, and it's cut its target price by 13%. It now stands at 800 rupees. The stock is currently trading at 916, so that's certainly a big downside for the stock even at this point. Incidentally, I didn't mention, it is currently trading at over 2 times price to book even at these levels. What are they saying though? They're saying that the reported loss is the first quarterly loss ever. And this is on account of credit costs. The performance is reflecting a challenging condition in the MFI or the microfinance space. It is difficult to reverse the delinquency trends that they have been witnessing, what I was pointed out in terms of the portfolio at risk stats. And the key challenge is accelerated write-offs as well as the stress in the Karnataka and Tamil Nadu books. In the quarter gone by, the write-offs were more than 300 crore rupees. The guidance has been revised further across metrics. They're building in a lower return on equity of 14 to 17% over the course of FY26, that's the next financial year, to FY27. And they've also cut their EPS for FY26 by 16%. FY27 has been cut by 13%. So it's not going to look like a very good morning for Credit Access, Tamanna.
Credit Access in focus, banks in focus. You know, I'm just wondering, Avinash, what is the sort of budget momentum that you are seeing? We know that some capex announcements are expected, at least that's what the street is penciling in. Is this the day when you're looking at a weak open to build your positions in your typical budget plays, in your defense, railways, etc.?
I think, Tamanna, clearly, this time market expectations from the budget are very low. And I think my sense is the markets would be keenly waiting for finally what comes out on the 1st of February. I think today I would not be surprised that most investors or traders would like to keep their positions on hold because clearly the way global headwinds are shaping up, anything negative on the global market front could completely negate any upside kind of possibility. So I think, yes, I think, within the sectors which really look interesting are definitely, infrastructure, cement. Typically, my sense is, the hard sectors like typically, the capital goods sector. So these are sectors where I think the government could do a little bit of, policy announcements to encourage capital investments. At the end of the day, housing continues to be a very strong kind of mass kind of demand driver. So I think, I think real estate also could be a possibility where I think some positive announcements could come in. But I think overall the markets are not looking at anything extraordinary. I think the only thing the market is expecting is that no negative news or no negative announcement comes in, because last year capital gains tax was increased. That became a big disappointment, and I think this time markets are expecting that at least on the middle class front, some relief is given. Consumption measures to boost consumption is increased, because clearly the economy is in a downturn. Consumption has got affected very badly, and I think the government definitely will do something, but whether it will be completely positive for the markets is something we'll come to know only on the 1st of February. So I think it's better to wait and watch now rather than trying to buy it now. It's better maybe another week or so. I think everything will be very clear.
Avinash, I will certainly thank the finance minister as well for any tax breaks that she can give me.